These are the physics-based sentiment forecasts for the U.S. stock market using data as of April 4th, 2025. Our report has 3 figures, and this video focuses on figures 1 and 3. See the videos and web pages linked on each page of the report for background information on the figures. Our 3-week forecasts call for long-term physics-based sentiment is rated a 4, meaning most optimistic. Short-term physics-based sentiment to be optimistic mid-April, then pessimistic. Regarding a major flash, we expect one to begin week ending April 25th. Regarding minor flashes, we expect them to be varied over the forecast horizon. Our forecast for U.S. stock market price momentum, as measured by the 14-week RSI, is for it to be higher the week ending April 11th, then lower. Implied economics-based sentiment registers as meaningfully negative, which indicates that investors have a negative view of economic and market conditions. In summary, market reaction to the administration's tariff announcement has been severe. Of course, the timing of the announcements is unrelated to physics-based sentiment shifts. However, physics-based drivers can indicate how the market is likely to respond to the announcement and upcoming related economic concerns. The extreme magnitude of the recent reaction aligns with last week's pessimistic reading of the short-term driver and the meaningfully negative reading for implied economics-based sentiment. The MRI and Figure 1 are good indicators of the near-term direction of the market. The micro-MRI is now trending lower, indicating a negative near-term price outlook. As of last Friday, it stood at 30 on a 0 to 100 scale, suggesting prices may fall further. Historically, it has been best to buy when the micro-MRI enters the up leg of its cycle. The macro-MRI remains moderately high in its normal range and is trending negatively, another unfavorable condition for the market. Regarding a price recovery being aided by physics-induced optimism, the outlook is mixed. The long-term driver has a reading of most optimistic, which may mean that widespread investor panic is unlikely. Under similar historical conditions, market losses rarely exceeded 30%. The short-term driver is expected to be more optimistic this week and next, but shifts to a pessimistic stance the week ending April 25th. Perhaps the most important upcoming shift is a major flash that is expected to begin the week ending April 25th. We expect what we call an M flash because of its shape. An M flash typically lasts 8 to 10 weeks and involves seemingly erratic price moves. A series of M flashes are shown as the yellow line on Figure 2. One will soon enter the forecast horizon of this report. Historically, these flashes tend to overwhelm the long-term and short-term drivers on a short-term basis, so it is worth paying attention to this flash. The most pessimistic week, the low point represented by the middle of the M, is expected the week ending May 9th, which may represent a good time to buy stocks. For more information on the M flash, please see the web link on page 1 of the PDF. The lower panel of Figure 1 shows the physics-based sentiment drivers, indicating the naturally occurring shifts in investor sentiment over the last 52 weeks and the next 3 weeks. Physics-based drivers explain a large portion of stock market volatility, and we can create reliable forecasts for them several months in advance. The long-term driver remains most optimistic. The short-term driver shifts to an optimistic stance mid-April and then to a pessimistic stance. There is a major flash at the end of the forecast horizon. This particular type of flash lasts about 10 weeks and involves seemingly erratic price gains and losses. A minor flash of pessimism ends the week ending April 11th. The upper panel displays the price of an ETF tracking the S&P 500 equal-weighted index, shown as a dark blue line, along with our market resilience indexes, or MRI. The MRI are based on return acceleration and show the herding behavior of investors as they respond to physics-induced sentiment shifts and all other economic and market factors. They highlight major and minor market inflection points. The macro MRI is relatively high in its range, a level of 66 on a 0 to 100 scale. This is a moderately high level and suggests the long-term trend of the market could move lower from this level. The micro MRI is in the down leg of its cycle at a moderate level of 30 on a 0 to 100 scale. It, and stock prices, can decline further and still be within its normal range. The exceptional macro MRI is not present. In Figure 3, the upper portion of the figure shows market price as a dark blue line and the predicted price momentum as the solid red line. The solid red line shows the predicted price momentum moving higher through April 11th and then moving lower. Figure 3 also shows the smoothed excess RSI as the light green line representing the implied economics-based sentiment. This is an important indicator of investor sentiment regarding factors other than physics-induced optimism and pessimism. The factors can include economic, valuation, political, and other considerations. A meaningfully negative reading highlights the potential for future market declines even when the market moves higher. A meaningfully positive reading can mitigate future losses. Our implied economics-based sentiment measure is below the neutral level, shown as the dashed green line, indicating meaningfully negative sentiment related to real economic and market factors. This condition began at the end of January 2025 and is likely to continue over the next few weeks, even if the stock market moves higher. Should this condition continue, it will amplify price declines and dampen price recoveries. Contact me with any questions. Thank you for watching.